Welcome to the Daily Update. This is Being Prepared Monday, April 11th, where we'll look at the action in the market today and then see how things look for Tuesday, April 12th. And just as a side note, I think I might have finally been able to locate the power cord that I need for the laptop that has the better software and the better microphone. So the hope is, if I can get it, because I have my own supply chain issues to deal with, and if it's the correct cord, hopefully within a week or so, the video quality should be a little bit better based on what you see as well as what you hear. So at least that's the hope. So how was Monday? It was pretty negative. The fixation right now is interest rates, our interest rates, because they're really going up. That's having a real impact on growth stocks because they have to borrow money to be able to grow. And when interest rates go up, that costs them more to borrow that money, and that really feeds into their revenues and their earnings. So as interest rates are going up, we're seeing real weakness in growth stocks, and that's pretty much what we saw. And we've turned over to a pretty solid negative environment right now with after Monday's decline. So right at the open, we did gap lower and we actually gapped down to S2. Now these pivot points are calculated based on the previous day's action, at least on the 10-minute chart that I look at, and then what I show you. We didn't have a real broad range on Friday, so that made the pivots for Monday's session not really far apart. So that's why we were able to hit those levels pretty quickly. However, after we gapped down, we ended up dropping below S2, but we didn't go as far as S3. I did calculate it and I was ready to put it on the chart, but we didn't get down to that level. After we got done with that initial selling, we pretty much moved sideways for most of the day. There was really no attempts at rebounds. We didn't really break lower until we got near the end of the day. There was some late day selling and we ended up closing down 1.69%. I have to cough. Still dealing with that congestion to a degree. If there's one positive thing we can take out of this, it's that we had below average volume on a down day. But we've been seeing below average volume pretty much across the board, whether it's an up day, down day, or not much of a change. The technicals have pretty much switched over negative now. Those that are still positive are rolling over and could be going negative at any time. And right now I have to pause this. I apologize for that. Hopefully when this new cord comes, I can edit that stuff out quicker and I won't need to warn you before every time I have to cough. But we did see below average volume on a down day. Okay, technicals, negative. The big story right now is inflation and interest rates. Yes, we have our geopolitical concerns, and that could come to the forefront at any time. We have our supply issue concerns. We have oil concerns. But right now, what the markets are fixated on has to do with the inflation and interest rates. And that's going to be a big deal on Tuesday, too, because we have the CPI coming out, and that's when the inflation report comes out. So in tomorrow's video, that's what I'll be spending a lot of time talking about. And it's who knows what's going to happen there. Is it really going to shoot up? Is it going to stay the same? Is it going to surprise the markets and actually fall back a little bit? We don't know. So what are some notes that we can take based on what happened? The technicals are negative, and we did drop below the 50-period simple moving average on Monday. We'd already dropped below the 200. Now we dropped below the 50. Rising interest rates are impacting growth stocks, and I'll have the charts. And I have one or two new charts to show you, just kind of show what I'm looking at right now. One thing that's interesting is that the yield curves are no longer inverted. We have one or two of them that are at zero, but now they're coming out of that inversion. And so that's kind of interesting. And looking at the one chart that I'll show later, where I have all the yield curves on one chart, quite often we see a big bounce after prices go back to being more regular, at least interest rates or yield curves. Sometimes that can give a real boost to stocks. Is that going to happen this time? That's one possible scenario. But just because we're not inverted now, we could drop back in and have 1, 2, 3 of our yield curves actually go back inverted. It doesn't mean we're, out of the woods with that. So this might take a little bit of time to actually develop. And then something else may need to happen once we're back not being inverted anymore to help push stocks higher, if that's what's going to happen this time. And one interesting thing is, even though we're having some down days and we're getting deeper into our intermediate term range, sentiment is not really dropping. We're not seeing a real pickup in fear. That could be a concern. For us to be able to hit a significant bottom, we want people to think the end of the world is coming. And we want sentiment to be very, very negative. It's pretty much neutral now, and I'll show you that. There were no economic reports that came out on Monday. In the weekly video, I went through the current market valuation and the updates there. So please check that out. They usually only update those charts about once a week. So I just referred to it here. Our trend, we're still trendless. The ADX is below 20 and declining. Our bias is negative and our momentum is negative. So we're just not looking very good right now. Does that mean we'll get a bounce out of this? I don't know. We'll have to see what the CPI says on Tuesday. As far as sentiment, this is what I'm talking about. We were at 48 after Friday, we're at 46 now, and we're still pretty much in the middle. We want this thing to get way over here, where people think things are just ending as we know it, and then that's usually when the market drops. You can see over here, extreme a month ago. It was just about a month ago when we hit that bottom and bounced up out of that. We were at 15 at that point. We're at 48 right now. Okay, and then here's the chart, just showing that we're pretty much in the middle. The VIX did climb a bit. We were well above 20 on a closing basis, and it did rise as prices declined on Monday. And the bar chart also, we're starting to come back up into these moving averages as well. So I use the moving averages because they react more to price, or I use these lines because they're static numbers. And I've just found that I use them both together because the moving averages are more fluid and adjust a little bit easier, where the traditional way was to use static numbers. Then our VIX of the VIX also saw an increase on a closing basis, and it also increased on the bar chart. So it just means the VIX is starting to pick up a little bit of steam, and then the VIX itself is showing there's a pickup in fear. And then we want to keep an eye on this, on the ulcer indicator, because we're now crossing above the moving average and fear is starting to increase, but not extreme right now. This was when we hit the low back in March. This was another low that we've hit. We want to see this really go up if we're going to see some kind of a bottom. Now, it doesn't mean that we can't turn around and go the other way. It's just we're not seeing any kind of critical mass at this point. The sectors, every one of them was negative, with energy, actually, which has been doing the best lately. It did the worst on Monday. Oil prices did decline. Tech, of course, got hammered 2.5%. And let's see, yeah, nothing really worth pointing out here other than all 11 sectors were negative. Energy is still in the lead, even after we had Monday's decline since the all-time high. Utilities, healthcare, staples, they've been holding up, but not giving back some gains as well, where at the very end we have discretionary just getting hammered, tech getting hammered, communication getting hammered. All right, here is just the tech sector itself, and we were down 2.5%. So this is quite a bit below the moving average now. And what will be even more negative is if we stay underneath this moving average and the red line actually starts to roll over itself. This is actually an industry group, but this is the semiconductors. And I look at the SOX, we call it the SOX index, but this is part of the overall tech sector. And this just shows a lot of the weakness that we've been seeing, because semiconductors play such a huge role in the tech sector, where we've seen a recent death cross and then a lot of weakness lately. And we're both below both moving averages, but we're kind of at a short-term double bottom here. Will we get some kind of a bounce out of that? We'll keep an eye on this and see what happens. As far as inflation, the CRB was down 1%, but still is in a pretty solid overall uptrend. The CRB actually, well, it outperformed. It went down less than stocks did. So it's still in an overall uptrend. And this is what I use to measure the inflation against the S&P 500. And this is just an inversion of that chart, showing how the S&P has underperformed commodities. Our technical alerts, all negative with the NASDAQ. It went below 13.7, 13.6, 13.5. There was a bearish MACD crossover in communications. Oil, well, I guess that could be seen as positive as a consumer, actually fell below 95. Here's the intraday chart. Here's where we gapped lower. We gapped right down here to, I said, oh, this is tomorrow's R2. This was actually S2 right here. We went a little bit sideways. And right after the open, it looked, I was watching this going, okay, this looks like a little bit of a base. Can we go up from here? No, that's not what happened. We ended up breaking down below S2, going sideways, bouncing a little bit. And then here's the late day selling. And we closed right at the low on Monday. Okay, and then here's what it looks like on a daily chart, where we've now broken below the pivot. So on this chart, this is more of a negative bias on the daily chart. And we don't really have, I mean, we have some support levels around here, but we've got a long ways to go to get down here to S1, if that's what ends up happening. At the bottom, you can see where volume was below average. We're down now 8.01% from the all-time high, the way that I calculate them. So we're still a little less than 2% from being in correction territory. Growth is just showing a real weakness right now. Value on a comparison basis is showing more strength. This is taking the two indexes together as a ratio, which just shows that growth is losing that battle right now. This shows that value is winning the battle right now. This is the NASDAQ 100 against the S&P, where the big tech stocks are really underperforming the S&P, which the S&P isn't doing all that great, but this just shows that the NASDAQ 100 is doing even worse right now. Then here's our peer value index. It was down 1/3%, where if you look at the growth, it was down 2.25%. So even though value was down, it still outperformed the growth index that we look at. And then this is a new one. This is where I take the growth index and the value index and do a ratio. And it just shows how we are in an overall downtrend when you compare growth with value. And then these are a couple of ETFs. And I was trying to see where we're making a lower high in the index, but a higher high in the ETFs. I'm not quite sure what to make of that. Here, if you see that, here's the lower high on the index chart, where here is a higher high on the ETF chart. But they're both just showing that growth is really weak right now. As far as our trend, the ADX is still declining, even though it curled just a little bit. We're down at around 17. The red line is above the green line, so that means this is negative right now. The Arun is still flatlining. It's seeing a decrease in buying, but it's also seeing a decrease in selling, because it's still going back to prices that didn't happen all that long ago. So this really isn't giving us a lot of insight right now. Other times it'll be very helpful. No change in the decision point scorecard as of right now. As far as our breadth, we saw a decline based on price, and we continue to see a decline based on volume. The AD ratio has actually dropped below 0, so that's negative and declining. New highs, new lows continue to show weakness. both on our upper moving average, and we're seeing a decline in our 10-day moving average. The accumulation distribution is still positive, but getting weaker and is in danger of crossing below the moving average. On a positive note, you could see that the moving average itself is still going higher. If we drop below that and stay below that, this red line will eventually roll over. Short term, we're down below the 20 period moving average. We're dropping based on 20 period moving averages, dropping on the 50 and dropping on the 200-day moving averages. And then here's our spaghetti mess showing that we closed right at the 200-day exponential moving average. Most people tend to use simple moving averages, but this might be providing some support. But if we fall below this, there's really not an awful lot below us as far as moving averages that, at least based on what I plot, that could offer support. If we do go back up, there could be some resistance at these other points. MACD has crossed over negative and is declining. STO, declining based on price, declining based on volume. McClellan oscillator, below zero and declining. Stoke RSI, extreme negative. Williams percent R, extreme negative. So you could make a case that in the short term, we're becoming oversold. The force index also declining. Then here's just looking back 5 periods with the rate of change, we're getting to an extreme negative reading. This still could go lower, but sometimes when we've gone down fast, we've seen some kind of a bounce to kind of wear off this extreme reading. Intermediate term, we are below the 50 period moving averages, both of them. We started out at the simple and the exponential, and then even blew through the simple, going right into the close. Here's the 100-day moving average, and it shows that we're below the pivot point. This is the PMO, rolling, still positive, but rolling over, and it has already rolled over based on price and as well as volume. Here's our PMO study showing a decline in those PMOs that are rising, a decline in those that are giving buy signals, and flat to a decline with those that are even above zero. The BPI, this could be somewhat positive because with the drop that we saw on Monday, we didn't see a real downward move with the bullish percent index. And then here's the longer term view after giving an extreme positive reading. So that could be a little bit positive. Moving average rainbow, we're just slicing through it fast. This could also be somewhat positive, even though short intermediate term, we're negative with the stochastics. We're starting to give extreme readings here, but we're still in a downtrend when it comes to the full stochastics. The summation index is turned lower based on price and has been turning lower based on volume for some time. And here we're starting to see real weakness with our momentum oscillators. Some of these have already crossed negative. Some of them are rolling over and could cross over negative pretty soon. The CCI, haven't shown this chart in a while. This just is the 14 period chart showing an extreme negative reading. Vortex crossed over negative. We see the red line above the green line right now, and they crossed below this one area right here. So that's negative as well. And then I'm going to start looking at 2 RSI charts. For years, I've just used the 14 period RSI, and that's the upper one here. And it isn't as touchy. Well, if I drop to a 9 period, you can see where when we topped out with the RSI was giving us an extreme positive reading. So I'm going to start looking at more than just the one that I usually look at. As far as our trading systems, we are negative in the Elder Impulse. We are negative with the SPY. We are negative with the SAR. Different charts, we're looking quite a bit more negative with our Heiken Ashi chart. The Kegi chart is also looking negative. Renko chart drew in a red box. That's also negative. 3-line break is also looking negative. We had some new zeros go into the point and figure chart today. No signal was generated, but that double top breakout that we had been kind of hoping for, that's off the table. That's history now. And even though there's no signal based on the point and figure chart, we are looking more negative with these two red circles that were drawn. Long term, we are below the 200-day moving average, both with the arithmetic chart and with the logarithmic chart. That's negative. Mega caps, these are the big boys, down over 2.5% on Friday and declining and well below both moving averages. Then our special case starting to roll over again. It had been trying to give us a bit of a bounce, but is now starting to show some weakness. Our longer term moving average study declining in the 50, declining with the 150, declining in the 200. And then with the fib, and I went back and I've tried to make this a little bit smaller. This is just going from the low that we set back in 2021 in February. And I measured up to this point, and it just shows that we've now retraced from the all-time high. We're down at the 38.2%. Could this provide support, or are we going to break down through that? Broad market, here's the S&P showing a gap. That's not a real healthy look right there. The mid caps were more sideways and the small caps were weak, but they're also a little bit more sideways. So a lot of the weakness were in the big stocks on Monday. The small and mid caps didn't get damaged as much. Here's the Dow Jones Composite. We're breaking below both moving averages. And some of that has to do with the transports. This takes the Dow, the transports, and the utilities together and crams them into a composite index. And overall, it's showing weakness. Here, and this is a bit of Dow theory, where, yes, we're seeing a decline in the Dow. And I just use closing bases right here. This is, even though we upticked a little bit with the transports, we just got hammered over the last couple of weeks in the transports. And that has to do with supply issues, the rise in oil prices, some of the different problems that have been going on within the transport industry. A lot of the big brokerage outfits have downgraded some of the transport stocks. So that has really got the transports getting hit. Utilities, which have been doing quite well, has seen recent weakness. Here are the FANG stocks, down another 3%, just looking not real good right now. ARC also, after having what could have been a nice little breakout, gave up another 1 1/3% on Monday. The Dow still above the pivot. That could be positive, but we're below both the 50 and the 200-day moving averages. And here's our diamond system, the Elder Impulse. The diamonds using the Elder Impulse system is now negative, and we've dropped below the 65 period MACD. Is that a MACD or a moving average? Sorry, yeah, exponential moving average. And we are negative with the MACD box down below. Small caps down, but only about 2/3%, but we dropped below S1. Mid caps down less than 0.5%, and we're more sideways, but we're still below both of these moving averages, and we're still below the pivot. NASDAQ, these are growth stocks. So if we see real weakness, the NASDAQ's going to get hit, down over 2%, kind of in free fall, it would seem right now. NASDAQ 100 also looking quite weak, down 2.35%. And then the Vixen. You could say, okay, this didn't really climb all that much, but fear is climbing as we're seeing a decrease. So there's not an awful lot of hedging going on, even though we've seen a really big fall right here. We're not seeing a real spike up with the Vixen. It's going up, but you might expect it to go up even more than it already has. Here's the Qs with the Elder Impulse system, decidedly negative. NYSE, a little more positive in that we're still above the pivot. We're still above the 50-period moving average, but now we're below the 200-day moving average. The S&P 100 has really been underperforming the rest of the S&P 500 recently. Wilshire also right at the pivot. Okay, we're still below moving averages, but this could provide a little bit of support. And this is a broad-based measure of the market. With our KST, it still shows that we're positive, but these, if you can see that, these are really starting to roll over. China, they're kind of in a world by themselves, but these other indicators are showing some weakness right now. All stocks also had almost a 1.5% decline on Monday. Looking at our world stocks, these are the non-US world stocks. They were actually up 0.5%. Some other broad market issues. The dollar was just been screaming, and right before I started recording, the dollar just went above 100, and it could very easily fall back. And Bitcoin just fell under 40, so it's in the high 39s, but it could also bounce back. This is hours before the market opens, so lots of different things can happen. But to see this strength in the dollar is, and it might be adding to the weakness in the stock market because of the conversion rate. The stock market tends to like a weaker dollar. That makes their books look better. It makes their conversion rates go more in their favor. So that's also adding to some of the overall weakness. But getting back to the dollar, well, I'm still on the dollar. Here's the weekly chart so far. But as interest rates go up, that means it costs more to borrow dollars. And that's why we're seeing an increase in the value of the dollar. Here's gold, dropped down to close at 94.29, still very high, but well off the 130 that we had hit not too long ago. Gold up just a little bit with the futures contract, up 0.5% with the ETF. And here's the longer term view of the GLD ETF. Silver, it actually had a better day. It was up 1.45%. We have a recent golden cross and we're above both moving averages. And here's a longer term view of the SLV ETF. Bitcoin, again, this closing basis right here was just at about 40. As I said, intraday it was dropping below 40, but that could change anytime. As far as bonds, I'm not going to show all the yield curve charts now. I'm just going to show this one chart, and it might be a little hard to see. And again, if you want this chart, just send me an email and I'll be glad to send that to you. It's showing that all of these yield curves are now either at zero or have gone back positive. As yields get just kind of skyrocket quite a bit higher, and they're still all jumbled up. So even though they're no longer inverted, they're still pretty close to each other. But that inversion could change again at any time. Internationally, we're just seeing a real spike up, except for Japan. We're seeing a real spike up in interest rates when we compare 10-year bonds. When we look at the price of bonds, they're just breaking down and almost in a free fall right now, down over 1%, according to this index. Corporate bonds also seeing recent weakness, and the current yield jumped up to 3.6%. Then junk bonds, and I have another chart right after this. Junk bonds tend to follow the stock market. It was down, so junk bonds based on price were down. And this, I went to the Fed website and actually found the yield. This is what you would get, 6.26%. Now remember, these are junk bonds. But the reason I bring this up is people are fighting to find some kind of a return these days. They're not getting it out of ultra safe treasuries. They're worried about putting it into the market. It's not like, unless they get into high dividend stocks. So some people might even be willing to get into junk bonds, which can be very risky. It's risk versus reward. That's why they pay a higher yield. And we are starting to see the yield of junk bonds going up, even though it has historically been much higher than what they are right now. So I'm going to start to include this as part of the daily video. Relative gold outperformed the stock market, or at least the S&P on Monday. This ratio was up 2.22%. Are we going to see another little attempt at a breakout? It had been failing. Is it going to be another fake out? We just have to wait and see how things play out. Here's energy against the S&P. It was down 1.32%, but still showing a pretty solid breakout nonetheless. And here is energy against tech. This is a newer one that I'm showing here because we have energy, which has been just skyrocketing up and doing really well, and tech, which has been showing a lot of weakness. Well, it's just showing how energy has been really outperforming tech lately. And then here's growth against bonds. Bond prices have been doing terrible. Growth stocks are having a lot of trouble. And so we were just kind of flat. We were down 0.77% with this ratio, but it just shows that growth is still outperforming the price of bonds, even with all the recent weakness that we've seen. Here is tech against the S&P, which is really underperforming the broader market right now. And this is tech against the 10-year. It just shows that interest rates are going faster than stocks are going up with tech. And and I have another chart to show with this too. We're seeing a real strong inverse relationship. Interest rates go up, tech stocks go down. And I actually have a correlation chart that I'll show right here. This is a new chart. I haven't shown this one before. To kind of explain this a little bit, this red dotted line, this is the 10-year yield. And you see how it's going up and up and up. The black line is the tech sector and how it's been going down and down. Down below, this is a correlation. If the two move completely hand in hand with each other, we would see a correlation of 1. If there's really no correlation, we would see it around 0. If we get all the way to -1, that means that they move in complete opposite directions. And that's what we're seeing right now. As interest rates are going up, we see tech really going down. Now, there have been other times when they've moved more in lockstep with each other. There's other times when they move in inverse relationships with each other. Right now, this is the big thing that's happening. And we want to see, is this relationship going to continue? There was, what was it, in 2021, we started to see a real strong correlation here, but then it wore off, it went away. But we weren't in a real high inflationary environment. There was a perception that we might be getting ready to have more inflation, but it didn't materialize. Now we're actually seeing that played out. So we want to keep an eye on this and see just how long this relationship exists. And then here is the yield compared to tech, just showing that, again, just showing the interest rates are really outperforming the tech sector right now. And then discretionary is really showing a lot of weakness when compared to staples. And here's the S&P also. Stocks are really taking, interest rates are really taking the S&P down. Then here's the low volatile stocks. They did decline 0.75%, but they did better than the rest of the S&P. And it actually declined or went up almost a full percent when you compare the ratio with each other. So what is our outlook then for Tuesday? The technicals, yeah, you pretty much have to say they're negative. Now that can change at any time, but right now, the picture that we see shows them as being negative. The markets remain in a trendless, and I added that word, intermediate term range, because the ADX is now showing it's now below 20 and declining. There's this daily value growth battle going back and forth. The real fixation continues to be interest rates. We still have the supply chain issues. The lockdowns are still happening in China, and that could bleed over into the US economy. We have this CPI coming out on Tuesday, and then all of the different geopolitical events that I pretty much have already mentioned here. So what are our different scenarios? Okay, for us to continue down, if we see interest rates climb and inflation fears continue, that will probably continue to drive stocks lower. And our technicals are now pretty much negative. What could make us go up from here? We still have this positive backdrop after the yield curves reinvert. Now that doesn't mean it's going to happen right away. It could, but it might take some time to play out. If you look back at that chart with all the yield curves, once we went back to an uninverted situation, sometimes stocks get a real powerful boost out of that. Okay, so we want to be ready for that. The oscillators, some are still positive, but they're really rolling over. The moving averages, well, at least in the S&P, they're not really providing us much support. We've kind of, at least the ones that I plot, some of the longer term ones might help us out. But in some of the other indexes, we might see some support from the moving averages, and then some of the pivot points may also provide some support. So we're kind of grasping at straws right now, which is okay, because when everything is all looking negative at the same time, that quite often means that we might get a bounce. The thing that really concerns me is that sentiment. People are not freaking out about this. So that suggests that we still might have more room to go down. Okay, and then this is the scenario that's playing out right now. Number 3, we are in a sideways market because the ADX is below 20 and is still declining. So we might see a real slowdown in price movement with real choppy action, more like a treadmill. So our conclusion, and this should be Monday. I didn't change that. This should be for Monday, April 11th. The S&P is now negative overall. Short term, we're negative. Intermediate term is still slightly positive because a few of our indicators are still hanging in there, but even those indicators are weakening. And just like some of our oscillators are starting to weaken, and then we might get some support from moving averages and other indexes or from the pivot levels, and we close below the 50-period simple moving average. Long term, we've now switched back to negative because we are below the 200-day simple moving average. And then here's just a list of the different videos that I provide. My hope is to be able to do some of these monthly videos when I can feel that I'm doing a better quality job with these videos. So thank you. Have a really good Tuesday, and I will prepare the next video after Tuesday's session.